I'm John Weber. Insurers in recent years have increasingly been setting their sights on Latin America, despite its volatile past economically and politically. This widened scope for growth has been prodded along by economic conditions in other parts of the world. But the main lines for success, according to Andrea Keenan, Assistant Vice President, and economist Nancy Snyder, are being drawn within the region's borders and their rebounding economies.
Latin American economic growth has been relatively strong and stable, and concurrently with that, GDP per capita, or the population's wealth, has also been rising. And as we know, GDP per capita, or wealth, is an important determinant for insurance market demand.
Regulation has improved, so there have been higher levels of regulatory oversight. Certain regions within Latin America have become more attentive to global regulatory standards, and so it's begun to appear more secure.
The uncertainty right now occurring in Europe is making investors turn away possibly from these traditionally low-risk countries in Europe to the emerging markets.
There's a certain amount of risk occurring in the developed world, starting with Europe and the United States, and where you're getting moderate levels of growth and higher levels of risk. So a wise insurance company would probably be well informed to go into Latin America where there's higher levels of growth and the same levels of risk that have been there for historical times. So while Latin America has not changed a great deal relative to its past, over the past couple of years, I would say that relative to Europe and North America and the various sovereign crises that have occurred in those two regions, it is getting relatively more attractive.
We also note that in terms of political risk, Latin America does still have a weakness in that area, especially in terms of labor inflexibility. The legal system is very difficult to navigate. Also, the business environment is sometimes challenging for private businesses, including insurers in the region.
Between the increasing regulatory oversight, the growth that is occurring because it's an emerging market, the fact that it's a largely homogenous region with a similar language, similar history, and its GDP per capita, its wealth relative to other emerging markets is actually high. It's a desirable place to do business for insurance companies.
An enticement for insurers making a major push into the region is the generally low insurance penetration rates.
Latin America represents almost 10% of the world's population and about 8% of the world's gross domestic product, but in terms of insurance premiums, it only represents less than 3% of the world's total insurance market. So there's definitely room to grow there. It does vary widely by country, however. Chile and Venezuela are more in the 4% range, but some of the larger markets, including Brazil and Mexico, are just about 2%.
Brazil and Mexico are much larger than the other countries individually in the region, so those two countries are going to be the focus of any business plan in Latin America. Brazil opened a few years ago to reinsurance, where the government-owned reinsurer, the monopoly ended, and when that opportunity opened up for insurers around the world, reinsurers entered the market. Now, as a small hiccup to that process, Brazil has pulled back some of that openness that has occurred in that regulatory environment, but it continues to be a very desirable country relative to the rest of the regions. In Mexico, the regulatory environment, they're trying to adhere to Solvency II standards. So they're really trying to benchmark the region against the highest global standard of regulation. So doing business there is a safe bet for a good, stable business operation from an international perspective.
Chile has a relatively developed and mature insurance market, and it has pretty stable and relatively strong economic growth forecasts moving forward.
Also, interestingly, Colombia, which historically had some political volatility, is actually a very exciting market that's growing, and there is much activity both on the microinsurance sector and in direct insurance lines for a great deal of growth in the future. So there's a lot of enthusiasm from the international insurance community about Colombia.
Despite the positive outlook, obstacles still remain.
We do expect GDP to grow at an average annual rate of about 4% for the Latin American region as a whole, and we forecast that insurance premiums will grow on average 6% annually over the next 5 years. In the past, there were certain obstacles to growth in Latin America, especially inflation. Some countries even experienced hyperinflation in the 1980s and 1990s. It's been brought down to more manageable levels in more recent years, but the structural institutions that produced those hyperinflationary environments still exist in certain countries. Having said that, economic growth in Latin America is heavily dependent on the rest of the world, especially the price of oil, which can be heavily affected by the economic conditions in the rest of the world. So if Europe does enter into recession, that could have an impact on the price of oil and could lead to some volatility.
The market is hoping to increase insurance penetration, and that's something that the regulatory community in Latin America is trying to encourage. It's a very difficult thing to do because that's a structural challenge. To encourage a greater portion of your population to dedicate more of your income to insurance expenditures is something that requires a structural change, and there are certain programs in place, or talk of programs in place, that should be in place to help with consumer education so that awareness of insurance starts to grow. Sophistication in the markets is beginning to grow, and that should help increase it. But all of these things are very gradual. So there is optimism, but we don't know exactly how quickly the results will come from these kinds of efforts.